Hi guys, welcome to the video. In this video, we are going to talk about free cash flows. Now, this is the very fundamental concept if you are trying to value a company through DCF method. And this method, you might be aware that this is used in a lot of places. So it's very important for us to dissect and understand what do we mean by free cash flows, how to compute free cash flows, and also at the end of this video, there is one question that I will be asking you. Please answer to that question in the comments below. Let's see how well you understand the concept. All right, let's move on. Now, this video will cover the concept of free cash flows. Now, if we just break these terms into two parts, the first term is free and second term is cash flows. Now, we understand the term cash flows pretty well. What do we mean by cash flows? The cash generated, the cash used or the cash generated through the operations during the period, right? So this is the cash used or let's say generated during the period. All right, the cash used or generated during the period. Now, how will you use or generate the cash? Of course, by operating as a result of your operations. Okay, and why the term free over here? Free means simply after all the commitments. After all the commitments, that means now how can I define free cash flows? If let's say you're a student and a question is asked in an interview as to what is a free cash flow, then they don't expect you to keep answering through the formula. They're not asking about the formula, guys. They are checking if you know the concept or not. So free cash flows, those cash flows which is left with the firm after meeting all the cash commitments, after meeting all the commitments, what is the level of cash that is left with the firm? That is the concept of free cash flows. Now, this term, free cash flows, is again broken down into two components. The first component is free cash flow to firm. And we know this with a very common abbreviation, FCFF, free cash flow to firm. And the other part is free cash flow to equity, abbreviated as FCFE. Now, how do we define the term? Now, you know what is free cash flow, right? But what is free cash flow to the firm? Now, that cash flow, which is attributable to both debt as well as equity holders, right? Let's consider that there are only two types of stakeholders as of now in the company, debt holders and equity holders. So that level of cash flow, which is attributable to both debt as well as equity holder, it is at the overall company level. And when I say overall company level, they include both debt holders also and equity holders also, right? And hence free cash flow to firm. What is FCFE, free cash flow to equity? Now, I'm sure you might be able to make this now. That cash flows, those cash flows, which is attributable to equity holders. Now, that is free cash flow to equity. Very simple. Now, you know the concept now. Now, let's go on to the computation. How do we compute FCFF. What is the starting point of FCFF? Let me ask you this question. What is the starting point of FCFF? You might be dying to tell me this answer, right? Because that is what we know. We have read it in our theory, we have read it in academics. Earnings before interest and tax, EBIT, right? You all will agree with me. FCFF, the starting point of the computation is EBIT minus tax on EBIT. You add back depreciation, you subtract your capex, and you adjust your working capital changes. And this will give you FCFF, free cash flow to the firm. Now, if I stop this video here, then what you will be going back with is that this we already know. What has Ayush taught us extra? Right? There is no value addition. But if you are studying with me, if you are here with me, I can't let you go with just this much. There is always some value addition. We have to go to why behind the things. So, my very first question to you this time is, why do you start with EBIT? Why do you start with EBIT? Why? Why not EBITDA? Why not net income for that matter? Can you guess the answer? If yes, brilliant. If not, let's understand. Now, I want you to imagine a very, very broad structure of an income statement. What is the top line of the income statement? Now, top line, we haven't heard about it. So, always remember, guys, if I say top line, I am talking about revenue. Revenue is known as the top line. Now you might be entering into investment banking, you might be entering into corporate finance, and hence you are required or you are expected to have that kind of technical language at least, right? So you will be talking in terms of top line and bottom line of a company. Your boss, your seniors might ask you, hey, what is the top line of this company, or what is the bottom line of the company that you are valuing, right? So always remember, top line is the revenue. So revenue minus COGS gives us, gross profit minus SG&A will give you EBITDA, earnings before interest, tax, depreciation, and amortization, minus depreciation and amortization will give you EBIT, minus interest will give you EBT, earnings before tax, minus tax will give you earnings after tax or profit after tax or net income. And this is known as the bottom line. So top line, revenue, bottom line, net income. All right. Now, coming back to my question, guys, why am I starting with EBIT and not with any other metric over here? The answer lies in identifying. Can you tell me what is that level of profit or what is that level of income which is attributable to both debt as well as equity holders? Net income? No, net income is attributable only to equity holders, guys. Right? Now, I considered that we are having only two types of stakeholders, debt and equity here. So that's why I'm saying it is attributable only to equity holders. So net income is the earnings, right? It is attributable to equity holders. Why? Because you have already subtracted interest over here. If you have already subtracted interest over here, then that means you have already paid the commitments to debt holders. They are out of the picture. You have already paid interest. They are out. Now, whatever is remaining is between government and equity holders. But what are we computing? We are computing FCFF, free cash flow to firm. That means we have to take care of both debt holders as well as equity holders to be included, right? And that is the reason I start with EBIT, because at this level, this income is attributable to both debt as well as equity holders. Why? Because we are not subtracting interest here. We'll subtract the interest only after EBIT, right? So EBIT is that level of income which is attributable to both debt as well as equity holders, and this is the reason why am I including this EBIT as a starting point for my FCFF computation. All right, so I hope you will remember that. Now, see, as students, we are very much used to just cramming up the formula. And I know some of you might not agree with me, but deep down, you know I am telling the truth. If you go behind the formula, well done. Proud of you. But if you don't, at least this video will help clarify some concepts. And even if there is 1% value addition that you get after watching this video, I will consider myself to be successful in making this video. All right. So EBIT done. My next question to you. Tax on EBIT. Now, we know this is your broad structure of income statement. Now, my question is the tax that you subtract here, right? Let us consider EBIT, let's consider EBT to be 100. And let's assume tax at the rate of 30%. So, the tax that you get is 30. Now, my question to you is, in your income statement, you are showing this 30 as tax. Is this the same tax while applying this FCFF formula? So should it be 30 over here? Absolutely not. If you say yes, that means you need to listen to this very carefully. This should not be there. This is not the same as your tax in the income statement, guys. Why? Because in the income statement, you subtract the tax after subtracting this interest. But in your FCFF computation, you are not subtracting that interest. You have included that interest. And that is the reason I cannot take this to be the same as that of income statement. Right? I need this tax on EBIT. See this word, on EBIT. So whatever EBIT you are assuming, you multiply the tax rate and find out tax on EBIT. Then you add back depreciation. Why? All of you might be aware of this, that it's a non-cash item. Absolutely correct. It is a non-cash item, and that is the reason why I have added it back. Because I am computing cash flows. So I have to remove the non-cash items. Minus capex. Why? Because remember what we are computing. We are computing free cash flow to firm. Free cash flows, that means after all the commitments. Is capex your commitment? Absolutely. That's the capital expenditure that you have made. Right? So minus capex, and you will adjust the working capital changes. My question to you is, working capital changes. Let me give you a question over here. Suppose 2020 and 2021, accounts receivable for 2020, suppose it is 100, and for 2021, suppose it is 120. Now, what is the difference? 20. Accounts receivable has increased this year. My question to you is, while adjusting the working capital changes over here, will you add this 20 or will you subtract this 20? I want you to think very carefully and I want you to give your answers in the comment section below. Let's see how well do you understand this adjustment of working capital, right? So if you answer this right, this is going to be my next video where I will answer this question. And after that, one video coming for FCFE, explaining the computation of FCFE. I hope FCFF is comfortable now. And I hope there was at least 1% value addition that you got after watching this video. Remember, you do have to answer that question, guys. What is the question? I'll repeat one more time. Accounts receivable has increased from 100 to 120. You need to tell me, will you add this 20 as a working capital change or will you subtract this 20 as a working capital change? Answer will be in the next video, and I really hope you put down your answers in the comment section below, guys. I'll see you in the next video. Thank you so much for watching. If you like this video, please press that like button and please share this video so that I can benefit a lot of people out there.